So what is pricing power? In this short video, we'll go over this characteristic that some businesses possess and others don't, and how the difference that it makes on future business returns is like night and day. Let's start with two quotes from the greatest investor in the history of all investing. And that is, no arguments please, Warren Buffett. Warren Buffett has stated, "The single most important decision in evaluating a business is pricing power. If you've got the power to raise prices without losing business to a competitor, you've got a very good business. And if you have to have a prayer session before raising the price by 1/10 of a cent, then you've got a terrible business." This is extremely important if you want to pick your own investments. The first question you should ask is, what will happen to this business if they raise their prices? If you cannot answer, or if the answer is not a happy one, you should move on to your next idea. Of course, this is not enough. Finding an amazing business is great, but price matters. You can overpay for a wonderful business, and that will not end well. And this is the warning Mr. Buffett gives us on this second quote. A good business is not always a good purchase, but it's a good place to look for one. So keep in mind that after you have identified a great business, and that is one that can keep raising its prices without affecting its sales, next you will need to check if the price of the shares of this business is not outrageous. If you find that the price is reasonable, you're on a good track to identify a good investment. Let's now go over a practical example of two companies and what happens when they try to raise the prices of the products they sell. But first, don't forget to like and subscribe if you like this type of content. If you already did, many thanks for supporting the channel. To understand the power of being able to raise prices without losing market share, let's now compare two hypothetical companies. Company A is called the terrible company, and Company B is known as the money printer. Maybe these names are kind of spoilers, but bear with me. Let's now look at a simplified income statement of each of these companies. All public traded companies are required to issue these income statements on their annual and quarterly reports. So this is something you should definitely check if you're considering an investment. Let's imagine Company A is selling their products for $40 each, and they sold 1,000 units last year, making their total revenue $40,000. Now, if the cost of each product they sell is $20, they will have a total cost of goods sold of $20,000. Which will then result on total gross profit of $20,000. But all companies have fixed costs that don't depend on the amount of units they sell. In this case, let's assume these fixed costs were $10,000, which brings us to the net income or bottom line, that is their profit of $10,000. Now, for simplicity reasons, let's assume in a given year, let's call it year 1, Company B had exactly the same results as Company A. But wait a minute, until now these two companies look exactly the same. But wait, things will start to change when both companies appoint new CEOs. The CEO of Company B decides to increase prices by $10. That's a 25% price bump. Because Company B has a strong brand, consumers continue to buy their product in the same quantities, leaving the number of units sold unchanged at 1,000 units. This is amazing news for Company B because if we assume that they can keep all their costs the same, their $10,000 increase in revenue will flow directly to the bottom line. If their bottom line also increases by $10,000, that is actually a duplication of their previous earnings. Did you notice that? A 25% price increase results in a 100% net income increase. That is why it is so fantastic to have a company that can increase prices while maintaining sales and keeping their costs low. But these companies are extremely rare. Capitalism is pretty brutal when there is competition, so most companies cannot raise their prices by 25% and expect to keep the same sales. Most companies are like Company A, where if they try to increase their prices by 25%, the most likely scenario is that their sales will drop significantly, let's say by 50%. If that happens, instead of increasing their profits, they will see their profits actually decline. And that is assuming that they can keep their costs the same, which is a big if, as generally costs are rising with inflation. So looking at these numbers, it becomes pretty obvious that raising prices has enormous impacts on companies' profits. Which is why sometimes experienced investors like Buffett are buying companies that can look seemingly expensive, but due to their pricing power can soon generate more than enough profits to justify their price. A great example of this is Apple. Apple was already a huge company in 2016 when Warren Buffett apparently noticed what most others didn't, that Apple could easily increase the prices of their iPhones and still keep its sales. Let's finish with a short clip of Warren explaining how he thought about the pricing power of Apple. Thanks for watching and see you on the next one.
Apple is different than the other businesses we own. It just happens to be a better business than any we own. And we put a fair amount of money in it, but we haven't got more money in it than we've got in the railroad. And Apple is a better business. Our railroad is a very good business, but it's not remotely as good as Apple's business. Apple, has a position with consumers where they're paying, maybe they pay $1,500 or whatever it may be for a phone, and these same people pay $35,000 for having a second car. And if they had to give up a second car or give up their iPhone, they'd give up their second car. I mean, it's an extraordinary product. We don't have anything like that we own 100% of, but we're very, very, very happy to have 5.6 or whatever it may be percent, and we're delighted every 0.1% that goes up. That's like adding $100 million to our earnings. I mean, our share of the earnings, and they use the earnings to buy out our partners, which we're glad to see them sell out too. The index funds have to sell if they bring the number of shares down. And, we went up slightly last year, and I made a mistake a couple of years ago, and I sold some shares when I had certain reasons why gains were useful to take that year from a tax standpoint. But having heard me say that, it was a dumb decision. Charlie, you've already given your comment about it, but we do not have 35% of Berkshire's portfolio. Berkshire's portfolio is the funds we have to work with. And we want to own good businesses, and we also want to have plenty of liquidity. And beyond that, the sky's the limit, or our mistakes, who knows what the bottom is. Charlie, do you want to add anything to your earlier comment?
Well, I think one of the inane things that's taught in modern university education is that a vast diversification is absolutely mandatory in investing in common stocks. That is an insane idea. It's not that easy to have a vast plethora of good opportunities that are easily identified. And if you've only got 3, I'd rather be in my best ideas instead of my worst. And now, some people can't tell their best ideas from their worst, and in the act of deciding that an investment already is good, they get to thinking it's better than it is. I think we make fewer mistakes like that than other people, and that is a blessing to us. We're not so smart, but we kind of know where the edge of our smartness is. That is a very important part of practical intelligence. And a lot of people who are geniuses on IQ tests think they're a lot smarter than they are. And what they are is dangerous. But if you know the edge of your own ability pretty well, you should ignore most of the notions of our experts about what I call diversification of portfolios.